Hello dear students. So we will be talking about a very important paper in ACCA, and the paper name is Foundation in Accountancy. Okay, that is basically F3 or Financial Accounting paper. Okay, so we are going to start with the Foundations in the Accountancy or the ACC F3 paper in Financial Accounting. And you must remember something very important, that this particular syllabus is, can you see, it is basically approved by ACCA, and the syllabus is substantially derived from the content reviewed by the ACC examining team. Okay, so whatever we discuss for F3 paper, that all content has been basically derived from the content reviewed by the ACC examining team. Okay, so let us start with, now before we start you have to remember there are various key two icons, right? So remember, this key basically means syllabus, the bulb means technical content, the question mark means questions to be considered by you, and the tick mark means the answer to the question. And when you see something like this, it talks about the question which came in the previous exam, and if you look at this, it means the answer to the past exam question. And this something which looks like a briefcase, like a case, is known as case study, and the globe means it is a real. Okay, so in this chapter we will talk about what is the meaning of financial reporting, right? And we will try to understand the nature, principles and scope of financial reporting. Learning outcome 2, we will also try to identify and define the different types of business entities, which could be sole trader, partnership and limited liability company. And we will also see what are the different legal differences between all the different business entities, right? And after that, we'll try to identify the advantages and the disadvantages of operating as each of the three types of business entity. Syllabus learning outcome 3, we need to identify the users of the financial statements, what were the users, and we will try to state and differentiate between their information needs. And the learning outcome 4 will be, we need to understand what is meant by governance, specifically in the context of the preparation of financial statements. And we will also talk about the duties and the responsibilities of the directors and the other parties covering the preparation of financial statements. Okay. And learning outcome 5 will be, we will try to understand and identify the purpose of each of the main financial statements. And then we will see what is meant by asset, liability, equity, revenue and expenses. So basically these are the outcomes which we are going to cover in this particular chapter number 1. So first of all of you have a look at this. We have the first thing very important is statement of profit or loss. As the name says, this talks about the profit or loss made by your company. And what is this? This we also call as balance sheet. Okay, this is also known as balance sheet. It talks about what? It talks about your assets, liabilities and capital. Okay, so remember, SOFP, which is known as statement of financial position, is nothing but also known as balance sheet. Okay, so all these are known as what? Financial statements, and of which these are used by the users of the financial information. Now, who are they? That I will talk about later. Then we'll talk about what governance means in the context of accounting, and we will also discuss three types of business entities. The first one is sole trader, second one is partnership, and third one is limited liability company, also known as LLC. Okay, so these are the three types of business entities I will discuss in this topic. Okay, so let us start with the topic. First of all, what is meant by financial reporting? Why we do it? Remember, financial reporting means it is nothing but a way of recording the data. First you record it, then you analyze it, and then you summarize it in the form of balance sheet and the profit and loss statements. So first we need to record the data, we need to analyze it, and then we need to summarize it so that we can do some kind of a understanding about the company financial performance. So what is financial data? Nothing but the name given to the actual transactions carried out by the business. Example is maybe sales of good made by the company. Another example could be maybe purchases made by the company. Another example could be when a company raises capital from the market. All of that is known as financial data. So now what you need to understand is financial data is recorded in the books of the prime entry. Books of prime entry mean that book in which the entry is made for the first time. Okay, and then transaction analyzed in the books of the prime entry, and then from the books of the prime entry the totals are posted. So we do the total part and then we post it to the ledger account. What are ledger accounts? Like, it could be machinery account, capital account, all these are ledger accounts. This you will understand later on when I talk about what is actually the books of prime entry and what is the ledger account. Okay, so what you need to understand is first we record everything in the books of prime entry. Then what we do, we analyze it and then we total the books and the totals are posted to the ledger accounts. And from there on, the transactions are summarized in the financial statements, which could be a balance sheet, remember, which could be also your income statement. Okay, and sometimes it also includes your cash flow statement. Okay, so all these are known as financial statement: balance sheet, income statement, and cash flow statement. Now, what is a business? As the name say, a business is nothing but which exists to make a profit. Okay, it exists to make a profit. So Reliance is a business, Infosys is a business, Apple is a business. So any company who basically exists in any of the market in the world, that is normally to make profit, and that is known as business. And when do you make profit? You make profit when your income is more than the expenses. Very important point. If income is less than the expenses, then what you will do? You will make losses. Okay. So remember, when income is more than the expenses, we make profit. When income is less than the expenses, we make loss. Okay. Remember this point. So now we come to the next part. What is meant by different types of business entity? The first one is sole trader. Sole trader means basically so remember, suppose you are having a small shop on the street. So a small shop on the street is known as sole traders. Okay, where basically it's a small business and the business is not incorporated and it is run by say 1 or 2 people. Okay, and they may have or they may not have any employees. So basically when you run a small business or a small shop, that is known as sole traders or the sole proprietorship. Okay, when there is normally only one owner. So normally we only have one owner, hence the name sole traders. Okay, what is partnership? Where basically 2 or more people, they join hands together to earn profit. For example, we call it partnership firm, like a chartered accountancy partnership firm. It could be a lawyer firm. So that basically means a firm has a number of partners and they work together, obviously to earn profit. And third one is limited liability company. As the name say, here the owners have limited liability, and the liability is limited to the amount they pay for their shares. That means if you buy a share of 100 rupees, okay, all you can lose is 100 rupees. You cannot lose more than the amount you invested. So the liability is limited to the amount you have invested, nothing more than that. That is known as limited liability. And one thing very important is the company and the company owner are separate. They are not one and the same. That means company is owned by the shareholders, but the company and the company owners are 2 different entities. they are not one and the same thing. They are two different entities. Okay. So that you have to understand that company and company owner is not the same thing. But remember, when you are the sole trader, the business and the owner is same. Here the ownership and the business is same. But in the case of this company, it is separate. So this is something what you need to remember. So now we'll talk about the various users of the accounts. Okay. So first user is managers of the company. What they do? They manage the company. We also call them managers. They are basically involved in the company day-to-day operations. Second one is shareholders of the company. What they do? They own the company. They are the company owners. So they are the people who actually buy the share of the company, and all the company profit belong to the shareholders. Okay. Then we have trade contracts. So who are they basically? They could be like your suppliers who supply basically various types of services or materials to the company. The next part is provider of finance to the company. So who are they? They're basically nothing but those people who basically provide money to the company. So this could be company creditors, okay, like debtors, banks, who basically supply the capital to the company. And then we have taxation authority. So what they do basically, obviously when the company make profit, the company has to pay a part of profit in the form of taxes to the income tax authority of that country. And yes, obviously how the company will work, company will only be able to work if the company has employees. So these people get salary, and then these people basically work for the company in order that company would be able to make good amount of sales and will also get good amount of profits. Remember, if the company has no business, in that case company will lay off the employees of the company. So it's very important for the employees to make sure that the company remain profitable. Otherwise, the company will simply fire those employees if the company is making losses. And then we have another user known as financial analysts and advisors. So what they do, they basically work for the various broking firms. And what they do, basically they look at the company financial statements, and then they try to find out whether company is a good investment or not. That means they give the advice to the investors whether they should or they should not buy the company shares. Okay, so we call them financial analysts, also known as okay. And then obviously we have the government and the agencies, right? So they are the entity who regulate the business, right? They are the regulators. So remember, all the companies must abide by the law of the country. So who enforces the law? The government and their various entities. And then obviously the public. Okay. All the company, they should make sure that they do not pollute the environment, and they also spend good amount of money for social benefit or social service. Okay. So that is public. So now the point is exam focus point. First of all, the need of the users can be easily examined. For example, you could be given a list of types of information, and you may be asked which user group would be the most interested in that information. That means they will give you the information with different types of information, and they will ask you to find out which user group would be interested in this particular information. Okay. So have a look at this. The question is what information would these users of the financial information be interested in? Okay, so we have how many users? 1, 2, 3, 4, 5, 6, 7. So they're asking you, let us know which all kind of information these people would like to want. Okay, so that's basically a discussion question. So let us see what the answer will be. Investors would like to know about company profit. Future prospect means how the company would be able to grow its sales in the future, how the company would be able to grow its profit in the future. And very important point, remember whenever you buy a company stock, you buy the stock to make returns. But remember the company may not perform well also, and that means risk. So you need to find out whether the company carries higher risk or lower risk. Remember, higher the risk, higher the expected return, and lower the risk, lower the expected return. And this is the most important point. Why do you buy a company share? You buy a company share so that the company's share price can go up. But it will only go if the company makes good amount of profit. So that growth in the share price is known as capital growth. Okay. And last but not the least is the company able to pay dividends? Remember, if the company makes profit, the company may or may not pay dividends to the shareholders. So remember one thing very important, dividend payment is not compulsory. Company may or may not pay the dividends. Something very, very important. Okay, remember. Now what are the various information employee would need? Again, they would need profitability. Remember, if the company is not profitable, company will fire the employees. Second point, yes. Will the company be able to grow in the long term? Because that is very important. If the company doesn't grow in the long term, company may not keep you as an employee. Third point, very, very important thing, security of the job. Remember, a larger company might have more stable business and a better security. For example, that is why many people, they want to work in the government. Why? Because government job is much more secure as compared to a private company job. For a private company, they work for profit. So whenever they think they're making losses, they don't mind, sacking the employees. And very important, if company makes profit, the employer would like to find out how much is the chance that they will get good amount of bonus. What is bonus? So remember, when you work in a company, you get a fixed salary. Plus, depending upon the targets you meet for the company, you may get some incentives. Okay, so that is not fixed, that is variable. So variable part is known as bonus. And how many employees work for the company? And very important point is, will the company be able to pay the pension to the employee once the employee retire? So you want to find out, even in the long term, will the company exist? And if yes, will the company be able to pay me pension when I retire? So all these are the information which you need from the which you need for the employees. Next one is lenders. Who are lenders? They're basically those people who lend money to the company. So obviously they want to find out whether or not company will be able to provide them return on finance. That means, will the company be able to pay the interest? And they also want to find out whether the company would be able to repay the principal. So both interest and principal. How much is the chance that company will be able to repay the both? And third point is, they would also like to know who are the other lenders who have given loan to the company and what kind of security company provides. Remember, sometimes company issues secured loans. Secured loans means where we give the capital to the company and that capital is secured by some asset. Okay, so in case the company is not able to repay the loan, that loan, if company is not able to repay, the company asset can be sold and money can be returned to the lender. So it's very important to understand, if the company is not able to repay the loan, what are the company assets which the lender can sell to recover their money. And then suppliers. Suppliers are basically providing various goods and services to the company on credit. So first of all, they want to find out whether they will get the payment on time or not. Very important point. Second point, very important, whether the company would be able to make the payment or not. Remember, when the company is not able to make profit, company may not make the payment to the suppliers. And third point is, if you think that there is a high likelihood company will not be able to make the payment, then you should decide whether you should continue to supply or whether you should stop supplying to the company, or company is not able to make the payment to the suppliers. And customers, very important. Customers want to make sure that the company would be able to sell the product and also service the product. Remember, you don't want to buy a car from the company and you come later on, the company has stopped the car manufacturing and the company will not be able to provide spare parts anymore. So it's very important for you to understand that the company will be able to continue and support the product you're buying from the company. And second point is, you also want to know the profitability, because if the company makes too much profit, that means maybe the customers are paying a high price for the goods bought from the company. So it's very important to understand how much profit a company makes. If a company makes too much profit, that means maybe the company is charging a higher price from the customers. And then we have the government and the agencies. Now what they do? They basically want to know the company profit and loss, how big the company is, at which growth rate company sales and profit is growing. Okay, how much time it takes for the company to pay the loan or pay the taxes, right? Which two taxes we have? Income tax. So all the company must pay tax on the income and they must also pay tax on the sales. Okay, so you must pay both direct tax and the indirect tax. Okay, very important point. You pay tax on income part and you also pay tax on your sales part. So this one is direct tax. Okay, and this one will be indirect tax. And what is foreign trade? Foreign trade means how much company import and export. And obviously we also want to know how much profit has been made by the company. So these are the various information needed by the government and their agencies. And public wants to know how much company contributes to the local economy. That means, do they spend money on school, building hospitals, or on the public welfare? Okay, so what are the various activities which are provided by the company? Okay, and information about the trend in the prosperity of the entity. So basically it all is a part of CSR. What is CSR? Corporate social responsibility. I repeat, corporate social responsibility, which means all the companies, since they're making profit, they also need to make sure that they contribute some part of the profit to the local economy in which they operate. So suppose if a company has operations in a particular city, then the company must also do something for the well-being of the city, okay, from the profit the company has made. And then we have governance. What governance means? Remember, we have directors, and the director main aim is to create wealth for the shareholder. That is, the company share price goes up. So all the directors have a duty of care to show they have good amount of competence. Competence means that they have the adequate ability to do the job properly. And in case they do something known as negligence, then they have to repay the company for the losses in case they do not discharge their responsibility properly. And all the directors are in a fiduciary position in relation to the company, which means they must always act honestly and they must always do what they think is in the best interest of the company and always in good faith, never in bad faith. That means they must not commit any fraud, any kind of cheating, and they must always make sure that whatever they do is in the long-term interest of the company and the company shareholders. And directors are the people who are responsible for the preparation of the financial statement of the company. Okay, so these are the people who actually make the financial statements. So in case the financial statements are made incorrectly, that means who is responsible? The directors are responsible. Okay, so remember this important point. So now the point is, what are the various types of financial statement? The first one is statement of financial position. Remember, I told you, we also call it what? We also call it balance sheet. Okay, balance sheet. And balance sheet is a list of all the assets owned and all the liabilities owed by the business at a particular date. Now, what is asset? Asset is something which the company owns. Okay, so company building is the company asset. But whenever a company takes a loan, that is example of liabilities. So balance sheet tells you the assets owned by the business and the liabilities owed by the business on a particular date. Very important. Balance sheet is always made as on a particular date. Okay, it is not for a period but for a particular date. And what is an asset? It is a resource controlled by an entity, that is a company, as a result of past events. That means you have bought something. Suppose I have a building. So that building was bought by the company in the past, and from which the future economic benefits are expected to flow to the entity. Now, since you bought the building in the past, we expect that building will continue to provide to you benefit in the future. Why? Because in that building we will have employees, and employees will work for the company, and company will make profit. So what are assets? They are nothing but something which company bought in the past and which company expects to get profit from in the future. We call it an asset. So remember this important point. Okay. Now what is a liability? A liability is a present obligation which is on your balance sheet arising from the past event. That means you have taken a loan in the previous year, right? And now you are going to pay something in the future. So basically it is a present obligations from the past events, the settlement of which is expected to result in an outflow from the entity of the resources which mean economic benefit. That means you have taken a loan, suppose in the past, and in the future you are going to pay something to repay the loan. That is a liability. Okay, it's obligation taken in the past and which must be repaid in the future. And what is equity? It is nothing but the residual interest in the asset of the entity after paying all the liabilities. So one thing which you need to remember is that equity is nothing but equal to what? Asset minus liabilities. That means suppose I have a house worth how much? Say 100 rupees, right? Or $100. Say $100, okay. And just let me correct it again. Just a second. So we have say asset. We have an asset worth $100, okay, $100. And suppose we have taken a loan of how much? We have taken a loan of $80. Okay, so the asset is of $100 and the loan is for $80. So if I sell the asset, how much will I get? I will get $100, out of which I must pay a loan of $80. So how much remains is $20. So this $20 will be my equity part. What is equity? If I sell the house for $100, what will happen is I will first repay the loan of $80, and then the remaining part, that is $20, is my equity. So equity is nothing but the residual part in the asset of the entity after paying all the liabilities. So equity is asset minus liabilities. So if the asset is of $100 and the liability is $80, so whatever remains after selling the assets and repaying the liability, that is known as equity. Okay, so remember this very, very important concept. Okay, so this concept you need to remember. Now, what is statement of profit or loss? It basically tells you the record of income made and the expenditure incurred. That means how much income you have made and how much expenditure you have incurred over a given period of time. That will be told to you by the statement of profit or loss. So it tells you how much income you made and how much expenditure you incurred for a given period. Say for a month, for a quarter, maybe for 6 months, or maybe for a year. So what is income? Income means an increase in the economic benefits during the accounting period in the form of inflows. That means you get something which would either increase your assets or decrease your liabilities. Remember, equity is what? Equity means asset minus liabilities. Okay. So whenever your asset increases or the liability goes down, that would increase your equity also. Okay. Other than those relating to the contribution from equity participants. Remember, equity can go up two ways. Either the asset goes down or the liability goes, or either the asset goes up or the liability goes down. But there's another way equity can go up. When the company raises money from the equity or the shareholders, then also the equity can go up. But in this case, we are going to exclude this. We will only look at those benefits like sales or profit in the form of inflow, which increase my assets or decrease my liabilities. That would result in an increase in equity. But this will not include those increase in equity relating to contribution from the equity participant. So if a shareholder participates and give in more money to the company, that is not a economic benefit. Okay, the economic benefit means something which flow to the economy which flow to the company through which the asset goes up or the liability goes down. So that is known as income. Okay, income means that a company is getting something in the form of say sales, profit, which increase my assets or reduce my liabilities. What are expenses? They are the opposite part. Expenses are decrease in the economic benefits because of which could be outflow and because of which the assets will go down or the liability would go up. And if this happens, my equity will also go down. But this will not include the decrease in equity because of distributions to equity participants. Okay, this will not be included. Expenses only include the outflow, or depletion means assets going down, or incurrence means liability going up. So when the asset goes down or the liability goes up, obviously company equity goes down. So that is known as expense. Okay. So now we do the chapter summary. So what is accounting? Accounting is a way of recording, first of all, then you need to analyze, and third but not the least is you need to summarize the business transactions. What is accounting records? All the business, they must keep sufficient accounting records so that they are able to produce accurate information to the users about the company financial activities. What is business entity concept? It basically tells you that the business and the business owner are not same. They are two different entities. And we also discussed there are three types of main business. The first one is sole traders and the partnership in which owners have unlimited liability. That means here the business creators can even touch upon the personal assets of the sole traders or the partners because they have unlimited liabilities. So that means you will bear all the risk and the rewards of being in the business. Your liability is unlimited. So if your business is running into a loss, so your partnership firm on the sole business, in that case, the creditors have all the right to touch upon your personal assets to get their money back. But if you are a shareholder in a limited liability company, in that case, your liability is limited to the extent of their investment. That means you can only lose what you invested, but you cannot lose more than what you invested. So the liability is limited. So very important concept to learn is if you are the sole proprietor or the sole owner or a partner in a partnership firm, in that case your liability is always unlimited. That means you will basically share all the risk and the rewards of being in the business without any limit. And we also discuss about users of the financial information, which means financial statements are used by a wide variety of users and every user will have a different information needs. Okay, so it's very important to understand that we need to satisfy the investor need, which means that the majority of the other users needs are also met. What is corporate governance? Corporate governance means is a process by which business are run and controlled by the managers responsible for running the business. Remember, it's very important to make sure the company management run the business in a ethical manner, that they should not commit any fraud, and they must portray the accurate picture of the company by making right set of financial statements. So all that is part of governance. Okay. And what is meant by pro forma financial statements? It means whenever company makes the financial statements, it must follow a prescribed format. Okay. So whenever company makes the financial statement, they must follow a format. But remember, there is no format for the sole trader statement of profit or loss and the statement of financial position. That means the sole trader do not have to follow any particular format, but the company must follow a prescribed format. Only then they will be able to make their financial statement as per the requirement. Okay, so that means now we have done the chapter number 1.